Welcome to The Explainer. Today, we're jumping into a financial strategy that pretty much flips the script on how we think about banking. It's called the infinite banking concept. And really, it's all about you taking back control of your own money. So, before we can really get into the solution, we've got to talk about the problem. And the problem lies with the traditional banking system. I mean, it's a powerful machine for sure, but we have to ask, who is that machine really built to serve?
Really think about that for a second. When you put your hard earned cash into a savings account, what are you actually doing? You're giving the bank a loan, but what's the deal you're getting on that loan versus the deal they're getting?
Well, let's just look at the numbers because they don't lie. The bank might give you, what, 0.5% if you're lucky to hold on to your money. But the moment you need a car loan, suddenly you're paying them 7%. That huge gap, that spread, that's the bank's profit. And here's the thing to remember, they're making that profit using your capital. Okay, so what's the alternative here? This is where the infinite banking concept, or IBC, comes in. And it's not just a different product, it's a completely different way of thinking about and using your own money, a real paradigm shift. And this is the absolute core of the idea. What if instead of parking your long-term savings somewhere you lose all control and profit, you could build your very own private pool of capital? A system where you set the rules, you control the terms, and you recapture the interest. At its heart, infinite banking uses a very specific tool, a dividend-paying whole life insurance policy. Now, hold on, it's not what you think. We're not using this for the death benefit primarily. This policy is engineered, it's specifically designed to maximize its cash value. Think of that cash value as your own private savings account, turning the policy into a financial engine that you can tap into whenever you want on your terms. Okay, I know what you're probably thinking. An insurance policy? How on earth does that work as a bank? So let's break down the actual mechanics here, because it's a cycle that, once you see it, is just incredibly powerful. It's really just a 5-step loop. First, you fund the policy by paying premiums. Simple enough. Second, that cash value starts to grow thanks to guaranteed interest rates and potential dividends. Now, step 3 is the magic moment. You need money, so you take a loan against your cash value. Notice I said against, not from. You're using your cash as collateral, and because of that, we get to step 4. Your entire cash value, every last penny, keeps compounding away as if you never touched it. And finally, you pay the loan back on your schedule, not the bank's, putting that capital right back into your system. This brings us to the most critical piece of the entire puzzle. It's a concept called uninterrupted compounding. And honestly, this is the secret sauce. This is what makes the whole thing work and sets it apart from, well, from everything else. This chart just illustrates it perfectly. Imagine you've got 100 grand in your cash value, and it's earning, say, 4%. Now you take out a loan for $20,000. Here's the kicker. With this strategy, the entire $100,000, that big bar, keeps chugging along earning that 4%. Not just the $80,000 that's left. You're literally making your money work in 2 places at the exact same time. The loan doesn't shut down your financial engine. All right, so let's do a little showdown. Let's put this head to head. How does borrowing from your own system really stack up against going to a traditional bank, hat in hand, and asking for a loan? This table just lays it all out nice and clear. Think about access. With a bank, it's applications, credit checks, waiting. With your policy loan, access is guaranteed, no questions asked. What about growth? A bank loan doesn't help your other assets, but with an IBC loan, your full cash value keeps compounding. And then you've got the big ones. The loans are tax-free, and you, not the bank, decide when and how to pay it back. It's a total shift from asking for permission to being in complete control. Now, it's super important to be clear about something. This is not a get-rich-quick scheme. It is absolutely a long-term strategy. So the real question becomes, who is this actually built for, and what does it look like over a lifetime? So who really gets the most out of this? Well, it's people who need reliable and frequent access to capital. So think about business owners who need to fund operations, or real estate investors making down payments, or even just families who want to pay for college or a wedding without derailing their entire financial future. But really, at the end of the day, it's for anyone who's just tired of relying on banks. So a common question is, how much do people actually put into a system like this? Well, a good rule of thumb is that people often allocate somewhere between 20 to 50% of their annual savings into the policy. And that's usually after they've already got a standard emergency fund set up. And you can really see how this strategy grows with you through your life. The first decade or so is all about accumulation. You're just building up that cash value engine. Then, for the next 20 years, you're in the leverage phase. You're using that capital for big investments, for life's major purchases. And then down the road, in the later decades, you can actually convert that cash value into a tax-free income stream for retirement, all while that death benefit is still there. You know, this quote just absolutely nails it. A properly designed policy isn't just one thing. It's your emergency fund, it's your opportunity fund, it's a retirement plan, and it's a legacy tool, all rolled into one private financial system that you own and you control. So we want to leave you with this final thought. It's a question that really gets to the core of what financial freedom is all about. For just a minute, forget about the interest rates and the policy details and just ask yourself, what could you do? What could you build if you never had to go ask a banker for permission ever again? What would that change for you?